Good morning. I'm going to be talking about receivables financing this morning, which I'm calling a guide to the perplexed. And this is an outline of what I'm intending to be covering. Basic arrangements of how the facilities work, some terminology, names for the different types of arrangements that you'll come across. Differences between disclosed and non-disclosed agreements, and differences between recourse and non-recourse agreements. Then towards the end, I want to talk about the estimated outcome statement and where you should be putting the financier in that. And the final point, we'll be talking about termination fees and charges. So let's start by looking at the basic arrangements. And the thing about invoice discounting, factoring and arrangements like that is they are really quite different from the more straightforward types of finance that businesses have. And the more straightforward arrangements you have are loans, and these will typically be either term loans or revolving credit, which is something like an overdraft. And a term loan is a straightforward advance of principal, a loan of money, which is then repaid with interest over an agreed term. An overdraft is slightly more complicated in that the limit there is the credit limit, which is the amount that the bank is prepared to let its customer borrow at any one time. But as long as the customer stays within the credit limit, then they can borrow as much as they want, whenever they want, and repayments will be at their convenience. And of course, typically, they will be borrowing from the overdraft simply by drawing from it, by paying other people, and they'll be making repayments, which will typically be debtors that are being paid to them coming into their overdraft. But those are quite straightforward. And bank facilities of that sort will usually be secured. Both term loans and revolving credit can be secured, and those sorts of secured arrangements are ones where the borrower, the bank's customer, continues to own the asset and they continue to have possession of it for as long as they're not in default under the finance agreement. And because the customer continues to own the asset that is pledged to the bank as security, they continue to have the right to sell it at their convenience. They'll have to pay the secured finance when they do so, but they do have the right to sell it. And in those types of arrangements, sometimes the finance will be connected to the asset, such as a mortgage to buy land, but sometimes it can be unconnected, where you will have a business that will put up perhaps its premises as security for the facilities that it's got from the bank. Asset finance, such as leasing and hire purchase, is a little bit different from that in the fundamental principle that the financier owns the asset. And that can be anything from lease of a photocopier right up to renting the premises that the business trades from. The rent is not payment of interest and principal, but very often the financier will have financed the asset themselves, will have paid to buy it themselves by borrowing money, and so the rent that they receive must be enough to repay the repayments that they need to make on it. With asset finance, the hirer does not necessarily have the right to buy the asset at the end of the term. You think, for example, of the arrangement for commercial leases for renting land and buildings. The tenant there does not have the right to buy the building. And similarly, the hirer may not, in many cases, will not have the right to sell the asset. And again, you take the example there of a lease of business premises. The tenant may have the right to assign their lease, but they don't have the right to sell the building as a whole. They don't have the right to sell the freehold of it. And it's very often similar arrangements with other types of asset finance as well. So moving on from that to things like invoice discounting and factoring, these sorts of debt finance arrangements, they're not loans. They are a type of asset finance. It is an arrangement by, we'll call them the trader in this presentation. It's an arrangement by the trader to sell the debts that they create to get cash in to their account sooner than would otherwise be the case. So you've got a trader who is selling their products on credit, maybe 30-day terms, maybe longer than that. And it is that credit the trader is giving to its customers that creates the debts. Those debts belong to the trader when they're created, and with an invoice discounting arrangement or something of that sort, the trader will sell those debts to the financier, and the financier will immediately pay a discounted price to the trader. So the trader has sold products worth £1,000. They've raised an invoice for £1,000, and rather than waiting 60 days for their customer to pay them, they will immediately sell that debt to the financier. They won't get the full £1,000 for it immediately, but they will get most of what's owed, which will provide them with the cash flow that they need in their business. And the trader's customer then will, in 60 days' time, will pay the debt to the financier and not to the trader. Once the debts have been sold, they always belong to the financier. It's a one-way street. The debt is sold, and it generally won't come back again. The trader may have a right to buy them back in some circumstances, but generally speaking, once the debt has been sold, it is now the financier's property and belongs to the financier. Looking at how the facilities work, they're usually set up as a revolving facility. So when the financier takes the trader on as their customer, they're likely to buy most of the debtor book at that time. They will usually audit the debtor book because they won't want to pay for very old debts, they won't want to pay for bad debts, and they won't want to pay for disputed debts. So they will exclude those from the purchase. And they will then pay the agreed discounted price for the value of the good debts in the book. There are likely to be setup fees and other expenses that are deducted from that price that is paid, that advance that the trader receives. And that will then continue, where as the trader continues selling products, invoicing its customers, it will sell those debts to the financier regularly, so that it's got money coming in all the time from this. The financier will cap the value of the debts that they're prepared to own at any one time. And the other key thing about this is that the debtors will be told that they must now pay the debt, not to the trader, but to the financier. And that's always done by giving the debtor the financier's bank details. The debtors may be given a bit more than that, but they, as the bare minimum, they will be given the financier's bank details. And when the debtor does pay the debt, it therefore goes to the financier. The financier is likely to charge a processing fee for that, and they will then adjust their own records of the debts that they have bought, the debts that they own, to record the fact that this debt has now been paid. And in many receivables funding arrangements, there is a second instalment of the agreed price for the debt, then is paid to the trader when the debt is received by the financier. If the debt turns bad and the debtor doesn't pay, then the financier is likely to have the right in the factoring agreement to ask for its money back. It's sometimes described as a repurchase of the debt. It very rarely is. It's a one-way route where the ownership of the debt will continue to be with the financier. They'll still own the right to receive that debt, but they will ask for their money back because what they bought has turned bad. And the arrangements for operating the facility is that when the trader completes their work for a customer, they will raise an invoice. The invoice will have the financier's bank details for payment on it. The trader will tell the financier that there is a new debt has been created, and it may ask the financier to buy that debt. Usually the factoring agreement will contain criteria for the debts that the financier is willing to buy, and if the debt meets those criteria, then the financier will agree to pay the first installment of the price for that debt. Most factoring and discounting agreements are whole turnover agreements, which means that all debts that the trader creates are transferred to the financier. They all become the financier's property, regardless of whether the financier is going to finance those debts or not. So even the debts that the financier will not purchase are transferred to the financier anyway. And for those, the trader does not receive an advance payment of the debt. They will have to wait until their customer pays the financier, and then the financier will pay the purchase price for the debt at that time. One of the features of these type of arrangements is there are plenty of creative opportunities for traders to misuse them, and it's worth knowing a little bit about what some of these are, if for no other reason than when it comes to doing your D report on the conduct of directors. One of the things that you are specifically asked to report on is if there has been misconduct in the operation of a factoring or discounting facility. So these are some of them. First one I'm calling anticipatory invoicing. And there's always going to be a temptation to do this, and it may be as simple as the job has almost been finished, the end of the month is fast approaching, it's not going to be completed by this month end, but we're going to finish it off early next week. So tell you what, let's invoice it in this month's invoice runs, and the financier will never know that we finished it a few days later. That's at one end of the scale. At the other end of the scale is, well, we've issued the contract to this customer, we've opened a job number for them, we've agreed a price, so we may as well invoice them now, and if they turn out not to instruct us, we'll issue a credit note next month. Then there's deliberate overcharging, and that would be linked with misuse of credit notes. Most discounting agreements would require the trader to notify the financier of all credit notes that they issue, and of course if they're a bit late in notifying credit notes, that gives them a bit of an advantage. Then moving down to the ones that are pretty much fraud, imaginary customers, where the trader's records will show that there's a job number being opened, there's been a contract issued, but in reality it's never left the premises, and that customer has never spoken to the trader. And diverting funds, where the trader tells the debtors to pay not into the discounter's bank account, but into their own bank account. And of course, if the financier discovers some of these abuses of their facility, then they're quite likely to pull the financing fairly swiftly. The financier themselves will need to run a number of accounts. They'll need accounts that show what the value of the approved debts, the good debts are that it has bought and now owns. So that will be taking off the value of those debts that have been bought and where the debts have been paid. They will need accounts to show how much it has agreed to pay to the trader in first and second installments of the purchase price for the various debts. And the customer's not necessarily going to draw all of the funding that's available to it on the day that it's available. It may be happy to have a surplus accruing to it in the financier's accounts so that it can draw that money when it needs it. And of course, the financier will be keeping track of the fees and expenses that they have charged, which will be set off against the funds available to their customer. So let's look at some of the terminology. There are many different names for arrangements of this sort: invoice finance, receivables financing, invoice discounting, confidential invoice discounting, factoring, and many others. There's no single definition of any of these, and some of these names are used interchangeably. Each financier tends to have their own name for their own products, which are often a little different from the products offered by their competitors. Some of the important terminology is the difference between disclosed agreements and undisclosed agreements. And typically, confidential invoice discounting is usually used as the description for an undisclosed agreement, and factoring is usually used as the name for a disclosed agreement. For disclosed agreements, the trader's customers are given formal written notice of assignment. They are told in writing that the ownership of the debt has changed, and the invoice that they receive will usually say on it, that will be the notice of assignment, that the debt has been assigned to, it will name the financier. That means that those traders' customers know that they owe the debt to the financier and not the trader. And that has some legal consequences. One is that now the trader's customer owes the debt to the financier, and if they pay the trader, that doesn't release them from the debt. So if they pay the trader after they've been given notice of assignment, they still owe the same debt to the financier, and they could end up paying twice. They also are likely to lose the right to make some deductions from what they owe the financier as well. Now, there are many types of debt that are non-assignable debts, and that is where the trader and their customer have agreed in the contract between them that the debt is not to be assignable. And that's particularly common in construction, for example, where the debts are almost always non-assignable. And the effect of that is that the notice of assignment won't work. That as far as the trader's customers are concerned, they can ignore the fact that the debt has been sold to the financier. And in confidential invoice discounting, there is no formal notice of assignment given. So although the trader's customers are told to pay the debt into the financier's bank account, they're not told that that's the financier's bank account. It's usually shown to them as being the trader's own bank account. You also sometimes come across recourse and non-recourse agreements, and these are basically about who takes the risk of bad debts, in that non-recourse agreements include credit insurance. So if a debt turns bad, the financier will claim on the credit insurance. If it's a recourse agreement, it means the financier will have recourse back to the trader if a debt turns bad. And if a debt is not paid within the agreed time, which would be typically something like 90 to 120 days, then the financier will have the right to ask the trader to repay the first installment of the price that the financier has paid for it. And in such circumstances, there are likely to be additional fees charged to the trader by the financier. The arrangements for debt collection and credit control vary from financier to financier and product to product. In some cases, the debt collection arrangements are essentially outsourced from the trader to the financier. And for many small businesses, that can be very useful to have as part of the financing package, to have people who are going to be chasing up payment of the debts that are owed to them. Other finance arrangements expect the trader themselves to operate their own credit control systems and procedures and enforce against late payers. Regardless of what the arrangements are, when you come across an invoice discounting or factoring agreement in the context of an insolvent business, the financier will almost certainly step in and collect the debts themselves, which of course they're entitled to do because those debts are their property. Let's have a look at what you do when you're putting together an estimated outcome statement. And there's a factoring or invoice discounting agreement there. Now, for practical purposes, what you do is you would show the debtor book as an asset of the company, and you would show the claims of the financier against it as being secured by a fixed charge on that debtor book. Now, keep doing that because that's the right way to show it on an estimated outcome statement, and it's quite clear to creditors, which is the purpose of the estimated outcome statement. However, conceptually, it's probably wrong because the finance agreement is actually a contract. So it will either have a positive value or a negative value, and I suppose it should really be shown either as a single debtor if it has a positive value, or a creditor if it has a negative net value. The debtor book, of course, belongs to the financier, not to the insolvent trader. So the debtor book itself is actually not an asset of the company. The other thing to remember when putting together the estimated outcome statement, of course, is that many of these financiers take backup debentures, and that gives them additional security over the company's assets if they are a net creditor. And that security may include fixed charges on some of the assets, but will almost certainly have a floating charge in it, and that floating charge is most likely to be a qualifying floating charge. Consequence of that is that the financier is entitled to receive notice of intention to appoint an administrator if they hold a backup debenture, and they are also going to have the right to appoint an administrator. Whether they can actually appoint an administrator will depend upon whether they are a net creditor under their funding agreement and whether they are entitled to call on the company for repayment of the net balance on that agreement. That can often be quite complicated to assess, and I suspect that it's not always checked as thoroughly as it should be when invoice discounters use their security to appoint administrators. Final thing to look at is termination fees and charges, and you will notice these if you're dealing with an invoicing arrangement or a factoring agreement. You might think that there's a positive balance in it when the directors first come in to talk to you about it. That positive balance will be a lot smaller by the time all of the fees and charges have been taken out of it. For example, there's likely to be termination charges. Typically, these arrangements are on, let's say, a 12-month rolling contract, which automatically renews, and the trader has got the right to terminate that contract, but only on an annual anniversary, and only if they've given at least 3 months notice, and they're perhaps not able to give that notice more than 6 months before the anniversary. So it can be very, very difficult to bring the agreement to an end. And if it's got to run on for another 9 months before it gets to its termination date, then you may find that the financier is entitled to claim 9 months loss of profits from the agreement as one of its claims in the closing account. They're also likely to be charging their discount fees, which are what they will charge monthly as a percentage on the funds in use. It's analogous to an interest charge. There are likely to be various service charges. There may be a collect out fee, which is the charge that they will levy if they have to step in and collect the debtor book themselves. And there may be collection expenses, the actual cost of collecting the debts, as well as the general collect out fee. And there are also likely to be refactoring fees where debts turn bad and they're entitled to call back the price that they have paid for them. And there will also be a fee charged each time they have to do that. Now, I would just say that it can be worth challenging those fees and charges. The financier should be able to show you a reconciliation of the charges against the contract to show which clauses authorize them to charge those particular fees, and they should be able to show you a rate sheet to show contractually how much they are entitled to charge for each fee. It can be surprisingly difficult getting that reconciliation and that rate sheet from some discounters and factors. And if they're unable to produce those, then you've got the basis for challenging their charges. So that's covered the various points that I wanted to pick up. If you have got any questions, then please do ask them now. I don't think I've had any in yet. Just have a quick look just to see. No, I don't think so. So if that's it, I'll just remind you of a few future dates. 16th of January next year, if you want to put that in your diary, the next coffee break briefing, I am planning to talk about retention of title claims. I'm hoping to have something a bit different to unveil to you on that occasion, but tell you more about that in the new year. If you're involved with R3 and in this part of the world, then there is the R3 regional forum being held in Reading on the 23rd and 24th of March next year. And big date for your diary, in May next year, the 12th of May, we have our second annual insolvency conference. And I hope to see as many of you as possible in person then. So with that, I'll just say thank you all very much for joining me today and for your support earlier in the year. Have a really great Christmas and New Year. Enjoy the break and see you again in January. Thank you all very much.